Okay, students, we're back, and I ended the last video by talking about gift cards a little bit and saying I would start with gift cards here. So, gift cards are a little bit tricky. Your book really doesn't tell you the whole story because how you handle gift cards is determined by state law, so it's going to vary from state to state. Now, a friend of mine was a state representative in Texas, and when he got elected, the first bill he actually authored extended the minimum length of time a gift card could be good for in Texas, I believe from 5 years to 7 years. So, because of that, I got to know a little bit more about gift cards than maybe most people know. Reality is, Texas is one of the states where unused gift cards actually are considered unclaimed property. And so if you have unclaimed property, you have unclaimed assets, someone else isn't entitled to just take that asset for themselves. It actually what's called escheats to the state. Now, when it escheats to the state, that money has to be turned over to the state, and the state holds it for the person it belongs to. It is never turned back over to the person who had it. So unclaimed gift cards, or that money that's associated with them, actually becomes unclaimed property if not used in Texas. Now, if you were a merchant and you sold gift cards and you knew that when those gift cards expired, you might have to turn that money over to the state, or if they remained untouched for some long period of time, you might have to turn that money over to the state. You might start trying to figure out a way to turn that money into revenue for you. And so most merchants have actually done pretty well with that. Uh, it is legally allowable for a merchant to charge a service charge on gift cards for maintaining the record of how much that gift card still has attached to it. And so what most merchants do is for maybe the first year or maybe even the first 2 years, there is no fee attached. But after some period, usually either 1 year or 2 years, then they start to charge a monthly maintenance fee on the gift card. And so that monthly fee might be $1, might be $2. Sometimes it's $2.50 a month. But let's just say it's $2.50 a month. Well, $2.50 times 12 months means that's $30 a year. So if you had a $100 gift card and you never used it, then the merchant might wait a year and then start charging $2.50 a month. And so in 3 1/3 years, 3 years and 4 months, they would actually use up that $100 in the fees that they're charging you. So they managed to convert that gift card money into revenue through that means and avoid cheating that money to the state. Okay, so now for purposes of the homework or for purposes of the exam, we're going to use what the book says. And basically what the book says is that when it's no longer probable that that gift card will be redeemed, you can go ahead then and treat that gift card unearned revenue as earned revenue. So you debit unearned or deferred revenue and credit revenue. Okay, let's do a couple of homework problems. So brief exercise 13.6 right here. On December 12, 2021, Pace Electronics received $24,000 from a customer toward a cash sale of $240,000 of diodes to be completed on January 16, 2022. What journal entry should Pace record on December 12th and January 16th. Okay, what we have here is a case of a customer giving you a deposit on a custom order, apparently. So December 12th, we receive $24,000 cash that we have not yet done anything to earn. So we're going to debit cash for $24,000, and then we're going to credit a liability, deferred revenue or unearned revenue for the $24,000. Okay. Then on January 16, we complete the sale, we deliver the diodes, and we have now earned this $240,000 in revenue. So we deliver those, and the customer pays us the remaining balance, which would be $240,000 minus $24,000. So that'd be $216,000 if my math is correct in my head. So on January 16, we received $216,000. So we debit cash for $216,000. We now have earned this $24,000 revenue, so we debit deferred revenue for $24,000, and we credit sales revenue for the entire $240,000. Okay, so there's January 12th. We debit cash, credit deferred revenue for the deposit the customer puts down. January 16, we debit cash for the cash received on that date. Debit deferred revenue because we have now earned this deposit. And credit sales revenue for the entire $240,000 received. Okay. Let's move on down to brief exercise 13.7. And so we will move to the problem. In Lizzie Shoes experience, gift cards that have not been redeemed within 12 months are not likely to be redeemed. Lizzie Shoes sold gift cards of $18,000 during August 2021. So, in August 2021, they're going to debit cash, credit, deferred revenue, gift cards. Okay. Now, of that $18,000 of gift cards, $4,000 of the cards were redeemed in September. So you're going to recognize $4,000 revenue, debit, deferred gift card revenue, credit sales revenue for $4,000, $3,000 in October, $2,500 in November, and $2,000 in December. So how much gift card revenue associated with the August 2021 gift card sales will Lizzie get to recognize in 2021 and 2022? So 2021, it's going to be $4,000 plus $3,000, that's $7,000, plus $2,500, that's $9,500, plus $2,000, $11,500. So $11,500 of revenue in 2021. Then in 2022, they're just going to recognize the rest of it because they figure after 12 months, it's unlikely any will be redeemed. So go back to the problem. In 2022, an additional $1,000 of cards were redeemed in January, $500 in February. So that's $1,500, but there were $6,500 worth of unredeemed cards. Apparently, they don't need to wait a year. Doesn't look like they got any more redeemed after about 6 months. So, so in 2022, they're going to go ahead and recognize the remaining $6,500. Okay. Now let's move on. Whoops, wrong one. Okay, now we move down to collections for third parties. Most common example of a collection for a third party is sales tax collected at the time of sale. We're collecting that for the state. So if you go to a store and you buy something for $100 and you take it to the checkout register and they ring it up, they don't collect $100 from you. Instead, they collect probably $108.25. I think the sales tax rate in Wichita Falls is 8.25%. So they're going to collect that extra $8.25 for the state of Texas. Now, how do they record that? Well, at the time of the sale, they are going to receive $108.25 from you. So they're going to debit cash for $108.25. Then they're going to credit sales revenue for the $100 of actual sales, and then credit sales tax payable for the other $8.25. Okay, so that recognizes that we collected that $8.25, but it doesn't belong to us. We owe that to the state of Texas. So there you see an example of an entry like that. Made a $100 sale, 7% sales tax. So they collected $107. Credit sales revenue for $100. Credit sales tax payable for $7. All right, let's look at brief exercise 13.8. During December, Rainy Equipment made a $600,000 credit sale. Sales tax rate of 6%, and the state sales tax rate is 6%. The local sales tax rate is 1.5%. Prepare the appropriate journal entry. So they're going to credit sales revenue for $600,000 and credit sales tax payable for another 7.5% of that, and then debit cash or accounts receivable for the total amount of the two. So there's our debit to accounts receivable for $645,000, credit to sales revenue for $600,000, credit to sales tax payable for $45,000. Okay, let's move on. They get into currently maturing portion of long-term debt. That's actually quite common. If you have bonds, serial bonds, where you're having to pay off a portion of those bonds every year, then the portion that's due within the next year should be classified as current portion of long-term debt. That also is true with the mortgage. So if you have a building that you bought and you have a 30-year mortgage on it, then the portion of the principal that's required to be paid off within the next year should be classified as current portion of long-term debt, as a current liability. The remainder of the principal on the note would be long-term liability. Now, you get down here, sometimes loans are callable, meaning the lending institution can just call you up and say, we're making that immediately due. If a loan is callable, or it has conditions in which it becomes callable, and those conditions are met to make it callable, you have to classify that as a current liability, because it could be required to be paid off with current assets. So if you have a callable loan, but it's only callable on certain conditions, and you're not in violation, then that can be long-term debt. But if it is callable, you have to treat that as a current liability. Okay, let me stop there, and I'll pick up there with the next video.